What if I told you that the smartest, most powerful people in business are all quietly heading for the exit at the same time? Something truly unusual has been happening this year. Between February and November, the world's absolute wealthiest individuals, the titans of industry, cashed out over $50 billion of their own company's stock. And they didn't do it quietly or gradually. They did it in massive, coordinated sales that have been setting off alarm bells all over Wall Street. Think about the names. Jeff Bezos sold a staggering $13 billion of Amazon stock. Mark Zuckerberg cashed out over $9 billion in Meta shares through a series of huge sales. Jamie Dimon, the legendary CEO of America's biggest bank, J.P. Morgan Chase, sold his own company's stock for the very first time in his entire 18-year career as CEO. You have Larry Ellison unloading $3 billion in Oracle stock. The Walton family is selling $3 billion in Walmart stock. And all of them are doing this while telling the public that everything is great, that the best is yet to come. But their actions tell a very different story. This isn't just about rebalancing a portfolio or planning for retirement. This isn't about saving a little on taxes. This is an exodus. It's a coordinated escape. And what's truly chilling is that they are doing it at the same moment, using the same playbook they used back in 2007, right before the great financial crisis wiped out $16 trillion in wealth and sent the market crashing down by 57%. Here's the part that most people miss. These aren't your average investors who get spooked by headlines. These are the legends. Jeff Bezos literally built Amazon from a garage into a $2 trillion behemoth over 30 years. He has lived through the dot-com crash, the 2008 crisis, the COVID pandemic, and he never ever sold stock like this. Then there's Jamie Dimon. He's been the head of America's largest bank since 2005. He not only survived the 2008 collapse, but he also saw his bank through it. He has seen every kind of economic crisis imaginable. And in nearly 2 decades, he never sold a single share of his own stock. Until right now. These people don't panic. They don't make emotional decisions based on fear. They operate on cold, hard data, deep analysis, and access to perfect information that you and I will never see. And right now, all of that data is telling them something absolutely terrifying. It's telling them to get out. So let me show you exactly who's selling and just how much they're dumping. I want to walk you through the 5 historical patterns that prove when insiders sell like this, a crash follows with near perfect accuracy. We'll look at the specific numbers these billionaires are seeing that the rest of us aren't, and why the setup for 2025 and 2026 looks more dangerous than any time since the Great Depression of 1929. We'll talk about who gets destroyed in these events, who actually profits, and what you can do right now to get your own house in order before the cascade begins, because this isn't just a wild prediction. This is pattern recognition, and the pattern is screaming that we have somewhere between 6 and 18 months before everything breaks. Now, before I show you the jaw-dropping list of who's selling, you need to understand what insider selling actually means and why it's the most powerful signal in the financial world. Insiders are the top dogs, the corporate executives, the board members, the major shareholders who have a front row seat to what's really happening inside a company. They have access to non-public information. And when they buy or sell their own company's stock, the law says they have to report it to the Securities and Exchange Commission, the SEC, within 2 business days. These reports are totally public. Anyone can go online and see them. But almost nobody does. So why does this matter so much? It's simple. Insiders know more than you do. Jeff Bezos doesn't just get a quarterly earnings report like the rest of us. He sees Amazon's daily sales data. He knows their profit margins in real time. He sees competitive threats and internal problems long before they ever make it into a press release. It's like he has a special weather radar for the economy that we don't. While we're reading last week's news, he's seeing the hurricane forming miles offshore. Jamie Dimon doesn't just read about the economy in the newspaper. He sees the raw data. He knows, in real time, how many people are defaulting on their loans, how many businesses are falling behind on their rent, how many credit cards are being maxed out. This is ground truth information that won't show up in official reports for months. And when these insiders see trouble brewing on the horizon, they do one thing: they sell. Some firms track all of this data, and the gold standard is a company called the Washington Service. They've been tracking every single insider transaction since 1975. They calculate something called the insider sell-to-buy ratio. It's a simple but incredibly powerful metric. It measures how many dollars of stock insiders are selling compared to how many dollars they're buying. Now, in a normal, healthy market, that ratio is usually around 2 to 1 or 3 to 1. That means insiders are selling $2 or $3 worth of stock for every $1 they buy. That's totally normal. Executives get paid in stock, so they have to sell some to diversify, pay taxes, or buy a house. A low ratio is just business as usual. But when that ratio spikes above 5 to 1, it's a yellow flag. It's a warning sign. When it hits 8 to 1 or 10 to 1, it's a screaming 5 alarm fire. And in 2024, that ratio hit 9 to 1 for the year. In some months, it spiked as high as 12 to 1. That means for every single dollar that insiders are investing in their own companies, they are cashing out $9. This is the most extreme imbalance, the biggest red flag we've seen since 2007. And we all remember what happened in 2008. Now, let's look at the specific names and numbers because the scale of this is truly unprecedented. Let's start with the king of them all, Jeff Bezos at Amazon. In February of this year, Bezos announced a plan to sell 50 million shares of Amazon stock. Over the next couple of months, he did just that, selling about $6.5 billion worth. Then, in the summer, he filed another plan to sell 25 million more shares, cashing out another $6.5 billion. All told, his sales in 2024 have been over $13 billion. Let me put that into context for you. Bezos started Amazon in his garage in 1994. For 30 years, he's been the company's heart and soul, and its biggest individual shareholder. Sure, he sold stock before, but never ever on this scale or at this speed. His previous largest sale was back in 2020, when he sold about $10 billion over the entire year to fund his rocket company. This year, he's blown past that record in just a matter of months. It is completely out of character, and it's a signal we simply can't ignore. Now, those sales weren't just big, they were different. In the past, he might have sold stock spread out over an entire year, often when the market was recovering and prices were lower. But these 2024 sales, they are massive, concentrated, and happening while the stock is perched at an all-time high. And what was his public explanation for this sudden $13 billion cash out? He said he was moving from Washington state to Florida to save on state income taxes. Well, let's just stop and think about that for a second. Jeff Bezos has been a billionaire since 1999. He could have moved to sunny, tax-free Florida any time in the last 25 years. He chose to do it in the exact year that Amazon's value soared to nearly $2 trillion, and the market hit record highs. That's like saying you finally decided to sell your family home to save on property taxes, but you just happened to list it on the single day the real estate market hit its absolute all-time peak. This isn't about tax planning. This is expert market timing from one of the smartest business minds on the planet, and he's not alone. Let's look at Mark Zuckerberg and Meta. Throughout 2024, Zuckerberg has been selling and selling and selling. It's been a steady drumbeat of hundreds of millions of dollars every single month. By the time fall rolled around, he had sold over $9 billion in Meta stock. This is especially telling because Meta's stock has been on an absolute tear, rocketing up from a low of $90 a share in 2022 to over $500 this year. The company's value tripled, fueled by hype around artificial intelligence. And right at the very peak of that hype, Zuckerberg is cashing out billions. The official explanation? He's funding his philanthropy, the Chan Zuckerberg Initiative. And that's a noble cause. But here's the thing they don't tell you. Zuckerberg doesn't need to sell stock to do that. He controls Meta through a special class of supervoting shares. It basically means he has ironclad control of the company's direction without needing to own a majority of the stock. He could hold his shares forever, maintain total control, and simply borrow against them at incredibly low interest rates to fund his charity for the next century. But he's not doing that. Instead, he is selling his shares for cash at the fastest pace of his entire career, precisely when the stock price is going vertical. That's not just charity, that's exit timing. But of all the signals we're seeing, this next one might be the most important, the most chilling of all. Let's talk about Jamie Dimon, the CEO of JP Morgan Chase. Dimon became the head of America's biggest bank back in 2005. For 18 years, he was the ultimate captain of the ship. Through the 2008 financial meltdown, the European debt crisis, the COVID crash, through every storm and every recovery, Jamie Dimon held on to every single share of stock he was ever given. He was famous for it. He would preach to investors about the importance of long-term ownership. He even said that when a CEO sells stock, it shows a lack of confidence. He was the ultimate believer in his own bank and the American economy. Then, in 2024, everything changed. In February, the bank quietly disclosed that Jamie Dimon, for the first time, would be selling 1 million of his shares for around $160 million. The official reason given was estate planning and financial diversification for his family. But Jamie Dimon is 68 years old. He could have done estate planning in 2010, 2015, or 2020. He could have done it at any point in the last 2 decades. Why now? Here is what makes this so terrifying. Jamie Dimon has more real-time information about the health of the economy than almost any person alive. His bank handles trillions of dollars in assets. He has a god's eye view of everything. loan defaults in every industry, vacancies in commercial real estate, the health of consumer credit, and small business failures. He has the real data that won't show up in government reports for months. And for the first time in 18 years, that data is telling him to sell. That's not estate planning. That is the fire alarm. The list just goes on. Larry Ellison, the co-founder of the software giant Oracle, sold around $3 billion of his stock this year. Oracle's stock had nearly doubled, riding the same AI wave as everyone else. And right at the peak, Ellison, who's been with the company since it started in 1977, decided it was time to sell billions. This man is worth over $150 billion. He doesn't need the cash. He's selling because he knows the real story inside his company, and he believes the stock price has gotten way ahead of reality. Then you have the Walton family, the heirs to the Walmart fortune. This year, they've cashed out over $3 billion in Walmart stock. Think about that. The family has held this stock for over 60 years, through every imaginable market cycle. For them, Walmart stock is more than an investment. It's the family legacy. They rarely sell significant amounts. But in 2024, at the same time, all three of Sam Walton's children started selling huge blocks of stock as it hit all-time highs. What does it tell you when the founding families themselves are heading for the door? The pattern is undeniable. You have the most successful, most brilliant business operators of our generation, people who built trillion-dollar empires, people who have held onto their stock for decades, and they are all systematically selling at the same time. And when you add it all up, the total amount is just staggering. Total insider selling in 2024 has now reached $464 billion. That is the second highest year for insider selling ever recorded. Now, what was the highest? The highest was $650 billion in 2007. Let me repeat that. The only time in modern history that insiders have dumped more of their own stock than they are right now was in the year immediately preceding the worst financial crisis since the Great Depression, the year before the S&P 500 crashed 57%. And if the current pace continues, 2025 is on track to break that 2007 record. Now, let me show you the 5 historical patterns that prove this wave of insider selling isn't just a coincidence, it's a near-perfect predictor of market crashes. This isn't guesswork. This is history, and the data is overwhelming. Pattern number 1 is that insiders always sell well before the party ends. They typically start cashing out a good 12 to 24 months before the market actually hits its peak. Think about it. In 1987, right before the infamous Black Monday crash, insider selling had already spiked by 350% in the first half of the year. The market peaked that August and then collapsed in October. The insiders got out 6 to 8 months early. Fast forward to the year 2000, right before the dot-com bubble burst. Insider selling hit record levels in late 1999 and the first couple of months of 2000. The Nasdaq stock market peaked in March 2000 and then proceeded to fall by a catastrophic 78% over the next 2 years. Again, the insiders sold are right at the top. And then there's 2007. Insider selling hit a record of $650 billion. The market peaked in October of that year, and by March of 2009, the S&P 500 had fallen from a high of 1565 all the way down to 666, a 57% drop. The insiders had sold 6 to 12 months before the peak and a full year and a half before the market finally hit bottom. The pattern is crystal clear and consistent. The insiders, with their access to real-time data, see problems developing on the inside long before the public does. They start selling while prices are still high and everyone is still euphoric. The market often keeps going up for a few more months because regular investors and big institutions are still buying, completely unaware that the smartest people in the room have already left the building. Then the crash comes. The insiders who sold at the top, collecting nearly 100 cents on the dollar, are sitting on a mountain of cash. They watch from the sidelines as stocks fall by 50 or 60%, and then, when there's blood in the streets and everyone else is panicking, they come back and buy up all those same assets for pennies on the dollar. This is how immense wealth is transferred from the public to the insiders. They sell high, they wait, and they buy low. Pattern number 2 is all about that sell-to-buy ratio we talked about. The Washington Service has tracked this for nearly 50 years, and the data is unmistakable. Whenever that ratio of selling to buying spikes above 8 to 1 for a significant period of time, a market crash follows within 24 months. In 1987, the ratio hit 9 to 1 in June. The crash came in October. In 2000, the ratio was above 8 to 1 in the first quarter. The crash started in March. In 2007, it was at 8 to 1 by the middle of the year and spiked to 10 to 1 by the fall. The crash started in October. The pattern is perfect. 8 times in history the signal has flashed, and 8 times a major crash has followed. There have been 0 false signals. And where are we today? In 2024, the ratio has been at 9-1 for the entire year. And in the third quarter, it spiked to an alarming 12-1. This is the most extreme reading we have seen since 2007. If this 50-year pattern holds, a crash is coming. The clock is ticking, and it suggests it will happen in late 2025 or 2026. Pattern number 3, insiders in the most overvalued, bubbliest parts of the market always sell first. Back in 2000, it was the tech insiders who were dumping their stock while the NASDAQ was still soaring. They knew the valuations were completely insane. Companies with no profits were being valued at billions of dollars. It was obvious to them, so they got out. And what happened? Tech stocks crashed by 78%. Other parts of the market fell, but not nearly as much. In 2007, it was the insiders in the financial sector who sold first. The CEOs of Lehman Brothers, Bear Stearns, and Countrywide, all of them were selling huge amounts of stock throughout 2006 and 2007. They knew their companies were loaded up with toxic garbage assets, so they cashed out. And sure enough, the financial sector crashed by over 80%. So where are the insiders selling the most in 2024? You guessed it, technology and financials all over again. You have Bezos at Amazon, Zuckerberg at Meta, and Ellison at Oracle. All tech giants, and all of them are selling. And you have Jamie Dimon at JP Morgan, the biggest bank, selling for the first time. This is like a roadmap to the danger zone. It tells you exactly which sectors are the most overpriced and the most at risk. Tech is clearly in another bubble, this time fueled by AI hype. And the big banks are sitting on a commercial real estate time bomb, with billions in loans that are likely to default. The insiders know this, so they're selling. That tells us that tech and financials will likely lead the way down in the next crash. Pattern number 4 is simple but powerful. When the most successful, most patient, long-term holders finally decide to sell, you know the top is in. Jeff Bezos held Amazon for 30 years. Mark Zuckerberg has held Meta since he started it in his dorm room in 2004. Jamie Dimon held his bank stock for 18 years. Larry Ellison held Oracle for 47 years. These are not flighty day traders. These are the builders, the visionaries, who held on through every previous crash and every storm. The very fact that they are all selling now at the same time means they believe that current prices are as good as it's ever going to get. They've seen 2000, they've seen 2008, they've seen 2020. They know what a crash looks like from the inside, and they are choosing now to get out. That is the strongest signal possible that they view 2024 and 2025 as a generational top in the market. Finally, pattern number 5. This might be the most important statistic of all. Since 1975, every single time insider selling has exceeded $400 billion in a single year, the market has either crashed within the next 24 months or entered a painful multi-year bear market where prices go nowhere but down. In every single one of those instances, 1987, 2000, 2007, the stock market did not make a new all-time high for years afterwards. After the 1987 crash, it took 2 years to recover. After the 2000 crash, it took 7 long years. And after 2007, it took 6 years to get back to the previous peak. In 2024, insider selling has already blown past $464 billion. If this historical pattern holds, it means the S&P 500 will not see new highs above the 2024 or 2025 peak for at least 3 to 5 years, and possibly much longer. We are either at the top right now or just months away from it, and everything that comes after that will be decline and a long, slow recovery. The insiders are screaming this message with their actions. Now, let me show you what these billionaires are seeing that you're not, because the information they have access to is on a completely different level than anything a regular person ever sees. First, they are looking at a very simple, very powerful tool called the Buffett indicator. This is Warren Buffett's favorite way to measure the overall temperature of the stock market. It's a simple idea. You take the total value of all the stocks in the market and divide it by the country's total. Economic output, or GDP. Think of it like a price tag for the whole market. Historically, a fair price is somewhere around 80 to 100%, meaning the stock market is valued at about the same as the economy it represents. When it gets above 120%, things are getting expensive. And when it gets above 150%, you are officially in bubble territory. So, where is the Buffett indicator right now? It's sitting at an eye-watering 185%. This is the highest it has ever been in history, aside from a brief, bizarre spike during the COVID lockdowns. This means the stock market is currently valued at nearly double the entire U.S. economy's output. For that to make any sense, you have to believe one of two impossible things. Either the economy is about to magically grow by 50% overnight, or corporations are somehow going to double their profits from here. Neither of those things is going to happen. Corporate profits are already at record highs, and economic growth is slowing down. The billionaires know that this number has to, and will, come back down to earth. And for a number to go from 185% back down to a normal level of 100%, that implies a 46% drop in stock prices. They see this writing on the wall, and now you see it too. Second, they see another flashing red light called the Shiller P/E ratio. This is a more sophisticated way of measuring whether stocks are cheap or expensive. It looks at stock prices compared to the last 10 years of a company's profits, adjusted for inflation. This smooths out the bumps of the economy and gives you a much better long-term picture of value. The historical average for this number is around 16 or 17. When it drops below 12, stocks are a bargain. When it gets above 25, they're expensive. And when it crosses 30, you're in a bubble, plain and simple. Right now, the Shiller P/E is at 34. To put that in perspective, there are only 3 other times in history it has ever been this high. The first was in 1929, right before the Great Depression. The second was in 1999, right before the dot-com bust. And the third was a brief spike during the COVID bubble that was followed by a sharp 35% drop. Every single time this indicator has gone above 30, a painful market crash has followed. We are at 34 right now. The billionaires know their history, and that's why they're selling. Third, they see a mountain of debt that is making the entire system incredibly fragile. It's called margin debt. This is money that people borrow from their stockbrokers to buy even more stocks. When everyone is feeling confident and bullish, they borrow more and more to juice their returns. Margin debt is currently sitting near record highs. This is incredibly dangerous because this kind of debt is a double-edged sword. If the market goes up 10%, you make 20. But if the market goes down 10%, you lose 20 and you still owe the money. If it drops far enough, you get something called a margin call, where your broker forces you to sell your stocks immediately to pay back your loan. This forced selling pushes prices even lower, which triggers more margin calls, which creates more forced selling. It's a death spiral. Right before the 2008 crash, this exact scenario played out. We are at similar levels of debt right now. The insiders know that the moment the market turns, all this borrowed money will become rocket fuel for the crash. They are getting out before that cascade begins. Fourth, they see the commercial real estate market collapsing in slow motion. Office buildings across the country are sitting half empty because of the permanent shift to remote work. Buildings that were bought at peak prices a few years ago with cheap mortgages are now worth 40% less. And now those cheap mortgages are coming due. The owners have to refinance at today's much higher interest rates, which they can't afford to do. This is a ticking time bomb set to go off across the balance sheets of thousands of banks. Fifth, they see a massive debt crisis brewing in the corporate world. For the last decade, companies borrowed trillions of dollars at super low interest rates. But that debt is now starting to mature, and it has to be refinanced at today's much higher rates. A perfectly healthy company paying 3% interest can easily go bankrupt when that rate jumps to 7 or 8%. We are already seeing this happen. Corporate bankruptcies in 2024 have hit the highest levels we've seen since the aftermath of the 2008 crisis. And this is just the beginning of the wave. Trillions of dollars in corporate debt are set to mature over the next 2 years. The billionaires running these companies can see their own balance sheets. They know which ones can't afford to refinance. And they are selling their stock before the defaults really start to accelerate. And finally, they see the most important data of all, the secret internal numbers from their own companies. This is their ultimate unfair advantage. Jeff Bezos doesn't have to wait for a government report to know the economy is slowing down. He can see Amazon's real-time sales data. He knows when people start buying less or when his most profitable divisions start to see their growth slow down. Mark Zuckerberg can see in real time if people are spending less time on Facebook and Instagram. Jamie Dimon sees the number of people missing their credit card and loan payments ticking up day by day. This is the ground truth, proprietary data that won't show up in a public report for another 3 months. By the time you and I hear about it, it's already old news to them. They've already sold. By the time you and I finally see those bad numbers in an official report, the stock will have already collapsed. The insiders are selling right now because their secret internal data is telling them that growth is slowing down, profits are getting squeezed, and their stocks are massively overvalued compared to what they know is coming. When you put all 7 of these data points together, they paint a very clear and disturbing picture. Stocks are overvalued by 40 to 50% at a minimum. The economy is slowing down and heading toward a recession. Defaults on commercial real estate and corporate loans are starting to accelerate. The national debt is spiraling out of control. And the internal data at the biggest companies is getting worse. It creates a situation where the risk of holding stocks is terrible. The potential upside from here, maybe another 10 or 20% if the bubble somehow keeps inflating. But the potential downside, a 50 or 60% crash when it finally pops. If you're Jeff Bezos and you're already worth over $100 billion, does it really make sense to risk losing $10 billion just for the chance to make $1 billion more? Of course not. The smart play, the play they are all making, is to sell, protect your fortune, wait for the crash, and then come back and buy everything up at a 50% off sale. So the big question is, when does this all happen? Based on these historical patterns, when does the crash actually come? On average, the time between a huge spike in insider selling and the market actually crashing is about 12 to 18 months. In 1987, there was heavy selling in the spring, and the crash came in the fall, a 6-month lag. In 2000, the selling was happening right as the market was peaking. There was almost no lag at all. In 2007, the heavy selling happened all year long, right up until the crash started in October. The pattern consistently shows a 6 to 18-month window. We saw massive, record-breaking sales throughout 2024. So if that historical pattern holds, the most likely window for the crash to begin is somewhere between the middle of 2025 and the middle of 2026. And other things point to the same time frame. Presidential election cycles have a huge impact on the market. Historically, the second and third years of a president's term are when things get rocky. 2025 will be year 1, which is often volatile, but the real danger zone is year 2, 2026. The commercial real estate crisis is set to peak in 2025 and 2026 as trillions in mortgages come due. The corporate debt crisis also peaks in that same window. All of these different storm fronts are converging on the same 12 to 24-month period ahead of us. So my best estimate, based on all this data, is that the crash will begin sometime between the fall of 2025 and the summer of 2026. The actual trigger could be anything. It could be a major bank failure, a cascade of corporate bankruptcies, a panic in the real estate market, or some unforeseen global event. But honestly, the trigger doesn't even matter. The system is so fragile and over-leveraged right now that any shock, big or small, will be enough to start the cascade. And once it starts, the machines take over. The margin calls, the algorithmic selling, the ETF liquidations, it all feeds on itself. The S&P 500 could easily fall 30, 40, or even 50% in just a matter of months. Now, let me show you who wins and who loses in this scenario. Because in every crisis, there are winners and losers. The biggest winners, of course, are the billionaire insiders who sold all their stock in 2024. Jeff Bezos sold $13 billion worth of Amazon stock when it was trading near its all-time high. When the market crashes and that same stock is 50% cheaper, he can come back and buy twice as many shares for the same amount of money. He will literally double his ownership stake in the company he founded. Mark Zuckerberg will do the same with Meta. Jamie Dimon will do the same with JP Morgan. This is the game. They sell at the top, they wait patiently for the crash, and then they buy back at the bottom, massively increasing their ownership and power. The billionaires who sold this year will actually be much wealthier after the crash than they were before it. The other people who win are those who hold cash and gold. In a crash, cash is king. Cash is the dry powder that allows you to take advantage of the chaos. When everyone else is panicking and selling, you can be the one buying up incredible assets at bargain bin prices. This is how generational wealth is created. Gold also wins because it preserves your purchasing power. When a crash happens, you know what the government will do? They will print trillions and trillions of dollars to try and bail out the system. All that money printing makes the value of the dollar go down. Gold, on the other hand, holds its value. But who loses? The middle class. They lose the most, and it's absolutely devastating. The average middle class family has their wealth tied up in 3 places: its 401k or other retirement account, the equity in its home, and its savings account. In a crash like the one that's coming, all 3 get crushed. Most 401ks are heavily invested in stocks. People who are near retirement or already retired get wiped out. Imagine you're 65 years old, you've worked hard your whole life, you've saved responsibly for 40 years, and you have $800,000 in your retirement account. You're planning to retire next year. Then the market crashes by 50%. Suddenly, your life savings are just $400,000. You can't retire. You can't go back to work and rebuild. Your entire retirement plan is destroyed overnight. This is the tragic human cost of these events. Millions of responsible, hardworking people have their futures stolen from them simply because of bad timing. They were unlucky enough to need their money at the top of a bubble. And it's not just individuals. Pension funds that manage the retirement money for teachers, firefighters, and police officers will lose hundreds of billions of dollars. That means benefits will have to be cut, and some cities and states could even go bankrupt. The damage cascades through the entire system. Insurance companies, which hold billions in stocks and bonds, could become insolvent when both crash at the same time. This is how the system breaks. Everyone is connected, and everyone unprepared loses together. And the people who get absolutely annihilated are the ones who borrowed money to buy stocks. If the market falls by 50%, their investment is wiped out. They still owe all the money they borrowed. They are left with nothing but debt. This is the great and tragic wealth transfer. It's a transfer of wealth from the middle class to the billionaires, from the unprepared to the prepared, from those who followed the herd to those who saw the pattern and acted on it. So what can you do? You can't stop the storm from coming, but you can prepare your own house to not only survive it, but to actually profit from the rebuilding that comes after. Here are the steps the smartest investors take. First, you need to reduce your risk. If your retirement account is 80 or 90% in stocks, that's like sailing into a hurricane with all your sails up. It's time to take some of them down. This isn't about selling everything in a panic. It's about smartly reducing your exposure and raising cash. Yes, you might miss out on a little bit of upside if the bubble inflates for a few more months, but you will protect yourself from the catastrophic 50% drop that is coming. The billionaires are raising cash. You should too. Think of it as taking some chips off the table when you're on a winning streak. It's the smart thing to do. Second, consider holding 10 to 15% of your assets in gold. You can do this with physical gold coins or through a simple fund like the GLD ETF. Why gold? Because gold is your insurance policy against the chaos that follows a crash. When the system breaks, the Federal Reserve will turn on the money printing presses like never before. That flood of new money devalues every dollar in your bank account. Gold, on the other hand, holds its value. It's a financial life raft in a sea of devalued currency. It surged after the 2008 crash. It surged during the 2020 crisis. It will do it again. Third, and this is where you turn defense into offense, you need to have a buy list ready. When the crash happens, and there's blood in the streets, and everyone else is panicking, that is not the time to start wondering what to do. That is the time to act. You need to know right now which high-quality, bulletproof companies you want to own for the long term. Companies like Apple, Microsoft, and Visa, businesses with fortress-like balance sheets that will survive any storm. Make that list now. And when the crash comes, and these world-class companies are 50% off sale, you can calmly and systematically start buying. This is how you set yourself up for the next decade of growth. Fourth, a word of warning. Do not try to be a hero and short the market unless you are a seasoned professional. Notice that the billionaires aren't shorting. They're not making risky bets against the market. They are simply selling what they own and moving to the safety of cash. Why? Because shorting requires perfect timing, and the market can stay irrational and crazy a lot longer than you can stay solvent. It's like trying to jump onto a speeding train in the dark. Even if you're right about where it's headed, if your timing's off by a split second, you get run over. Just raise cash and wait. Fifth, protect your personal economy. In a major recession, which often follows a crash, unemployment can spike. You need to make your job and your income as secure as possible. And you absolutely must have an emergency fund of at least 6 to 12 months of living expenses in cash. This is non-negotiable. Having that cash reserve means that if you do lose your job, you won't be forced to sell your investments at the absolute bottom of the market just to pay your mortgage. And finally, you must prepare yourself psychologically. The crash, when it comes, will be terrifying. The news will be a 24/7 cycle of panic. Your friends and family will be freaking out. Your 401k statement will be a sea of red. Every bone in your body will be screaming at you to sell everything at the bottom, just to make the pain stop. You have to be ready for that. The only way to win is to have a plan and to have the discipline to stick to it. Prepare yourself mentally now so that when the chaos comes, you can act with logic while everyone else is paralyzed by fear. Let me end with this. The billionaire exodus is not a theory, it is a fact. Over $50 billion in sales from the world's most successful and knowledgeable investors. A total of $464 billion in insider selling, the second highest year ever. A sell-to-buy ratio at the most extreme level since 2007. This is not normal. This is not diversification. This is the smartest money on the planet screaming a warning from the rooftops. They see the same things you now see. The Buffett indicator in the stratosphere, the Shiller PE at bubble levels, the mountains of debt, the collapsing real estate market, and the secret deteriorating data from inside their own companies. And so, they are selling. The pattern from 2007 is repeating. Exactly. Heavy insider, selling 12 to 18 months before the crash. We are in that window right now. The crash is coming. The second half of 2025 through the first half of 2026 is the primary danger zone. Maybe it comes sooner, maybe a little later, but it is coming. The billionaires are telling you with their actions. $13 billion from Bezos, $9 billion from Zuckerberg, the first ever sale from Jamie Dimon in his entire career. These men are not wrong. They are simply early. But they are not wrong. You now have a choice. You can ignore this signal, the loudest, clearest signal since 2007, and just hope for the best. Or you can recognize the pattern, respect the data, and position yourself accordingly. You can reduce your risk, you can raise cash, you can hold some gold, you can prepare your buy list, you can get ready mentally and financially for what is coming. Because over the next 12 to 18 months, the game is going to change. The billionaire exodus has begun. The pattern is clear. The crash is coming. The only question left is, will you be ready?